So in terms of the specifics, we're looking to measure actual growth. We want to select and weight companies by their actual growth. We don't want to simply favor expensive firms. We're weighting by those fundamental measures of growth. The result is a nicely diversified growth index that gives us broad sector exposure. Specifically, we're using some of the income statement measures that Rob highlighted. We're looking at sales, past sales and profitability growth as measures of business performance. And we're looking at R&D growth in terms of investment in the future, a potential predictor of future growth in sales and profitability. And I'll note for these measures, it's particularly important for sales and profitability growth. We're using an average of 3, 4, and 5 years, and I'll explain a little bit more in detail on a coming slide why it is that we're varying the starting points. But first, I'll note that in terms of combining these, if in doubt, our default is normally to equally weight signals. Because while sales growth and profitability growth may have worked slightly better, ever so slightly better than R&D growth over the period that we tested it, that doesn't mean that we have any ex-ante expectation that they'll necessarily outperform R&D growth in the future. And in fact, if we look at different markets, we look at different time periods, the winners and losers, the one that's actually best, it will trade places. There's no statistically significant difference when tested across multiple time periods and multiple regions. So we're just going to simply equally weight these. But the broader point is that regardless of the measure of fundamental growth that you pick, all of them are going to outperform a cap-weighted index that's largely favoring expensive companies. Selecting by growth, weighting by growth gives you a better experience than simply weighting by market cap, an expensive portfolio.
Let me just interject a quick observation. A natural question here would be, well, why not just drop R&D growth? Empirically, it would work a little better if you did. We don't do that. The quant community is addicted to data mining. Past is not prologue. The fact that it worked a little less well in the past, it tests out the history says it's a good idea. We don't know which of these will be the better idea going into the future. A lot of quants would look at this and say, oh, I can get a better backtest. You can get as good a backtest as you want by data mining like crazy. But that doesn't make for a better product. It often makes for a worse product. Back to you, Brent.
Yeah. I noted in terms of, and we've covered some of this already, but in terms of the signal, equally weighting these 3 measures, I noted that some of the components were averaging across 3, 4, and 5 years. Listeners who are, or viewers, this is video, viewers who are familiar with our RAFI work will know that we average our weights in RAFI across multiple years. That's to reduce cyclicality. It's to have more stable anchors to which we can rebalance. There's a similar rationale in play here with the fundamental growth series, in that we don't want to be reliant on one starting point for our measurement of growth. You can think of airlines coming out of COVID as a potential example for why you'd want to vary your starting points. If you use just 3-year growth, well, 3 years after the depths of COVID, when most of us stopped flying in 2020, if you were building a sales growth portfolio in 2023, all of the airlines would be near the top of the list. If you were looking at just a 4-year measure in 2024, most of the airlines would have been at the top of the list. So what you want to do is you want to diversify your starting point to give you a more stable anchor for your growth measures and reduce the potential that you're injecting cyclicality into the metrics. Because what our goal is, and ideally what we want to do for a growth index, is we want to measure companies that truly are growing quickly. not simply companies that are maybe benefiting from a cyclical peak that are likely going to see slower growth in the future once they get past that cyclical peak, or once they're past a cyclical bottom in their starting point. So we're averaging these measures across multiple years. We select the top 25% of companies by cumulative growth weight. That tends to get us to around 100 names. And of course, we're weighting them by the dollar magnitude. Just as in the RAFI Fundamental Index, we weight companies by the size of their sales, cash flow, dividends, and book value. Here, we're weighting companies by the dollar magnitude of their sales. So from a selection standpoint, you want to find companies that are growing at a fast rate. From a weighting standpoint, you want a liquid portfolio with large weights and large companies. You're getting that by favoring the companies who have large growth in dollar terms. So you're not going to end up with, say, a $100 million market cap company anywhere near the top of the portfolio. That's a bad example. That'd be too small to qualify in the first place. But you won't get a tiny little mid-cap name near the top of the portfolio because its growth percentage has been high. We want to weight companies by the dollar value of growth. So you have a very liquid portfolio that's very inexpensive to trade, large weights in the companies that have the largest dollar growth. And then similar to what we do with the RAFI Fundamental Index strategies, the legacy ones, we're applying a quarterly staggered rebalance. So this is the best of both worlds. You're getting an annual rebalance, but quarterly execution. So you're spreading out your trading across 4 days instead of having all your trades on a single day. Finally, I'll note some of the results very briefly before handing it back over to Rob. What I'll note, the returns are strong over the long run, as you would expect. But what I'll highlight, not simply because the one-year number is very good, but because of the environment that's created a strong one-year number, what we've potentially seen over the past year is the market beginning to care a little bit more, whether you want to call it the quality of growth or just growth itself versus just buying popular companies. As that shows up, as that market preference shows up, for perhaps not being shy about paying up for growth, but wanting to actually get growth, not simply expensive companies. When that happens, it's during time periods when that occurs that this strategy will really shine. That's when it gets a tailwind relative to growth indices that are simply favoring expensive firms. This is not, obviously, it's a very poor idea to make an investment decision based on 1 year of returns. But I want to highlight this simply because it points to the market environment that we've been in over the past year.